Hey everyone, welcome back to the Crypto Code. Today we're breaking down one macro signal that has recently flipped, and historically, it has been one of the earliest warnings that Bitcoin is moving from defensive conditions into a real expansion phase. It's not a chart pattern, it's not a narrative, and most traders completely ignore it. But by the end of this video, you'll understand why this single data point can matter more than almost anything on your chart. Let's talk about it. Before we jump into today's topic, we want to remind you that here at the Crypto Code, our goal is to provide you with the top news, research, and tips when it comes to finding projects with huge profit potential. Stay to the end of this video and learn how you can earn $10 in Bitcoin and a free weekly trade alert just for attending one of our free workshops to learn more about who we are and what we do. No purchase needed. Our trade alerts have a 93% win rate, so make sure you take advantage of this free alert. Remember, I am not a financial advisor. This is not financial advice, so do your own research before you make any crypto trades. Okay, so let's start with short-term market context. When Bitcoin trades in compressed structures on the lower time frames where higher lows begin pressing into resistance, it usually signals that the market is building energy for a directional move. In those environments, our approach shifts toward looking for relief rallies and mean reversion setups rather than aggressively pressing shorts. But a short-term bounce never means the market has structurally turned bullish. Until Bitcoin reclaims key range levels and breaks its broader downtrend, the environment should still be treated cautiously with smaller position sizing and tighter risk control. Now let's talk about why we still anchor everything to Bitcoin. If Bitcoin does not show real demand, most altcoins will not sustain upside. Short squeezes and narrative-driven moves happen all the time, but real market cycles only begin when capital consistently flows back into Bitcoin. That's why altcoin exposure should always be managed in the context of Bitcoin's broader structure. Before we get to the macro catalyst, there are two demand signals that matter more than price alone. The first is spot ETF flows. Sustained inflows indicate institutional capital is returning. Without consistency, rallies tend to remain fragile. The second is the Coinbase spot premium. This is one of the cleanest proxies for US spot demand. When the premium stays negative, Bitcoin usually struggles to trend. When it remains positive for extended periods, Bitcoin tends to perform much more strongly. These indicators help confirm whether the market is actually bidding on Bitcoin, not just trading volatility. And now let's get to the one macro signal that actually matters. The U.S. manufacturing PMI, also known as the ISM index, has recently moved back into expansion territory. This is far more important for Bitcoin than most people realize. Bitcoin is not only sensitive to liquidity, it is also closely linked to the U.S. business cycle. Across multiple market cycles, the pattern is very consistent. When the ISM bottoms, Bitcoin often forms major cycle lows. When the ISM enters a sustained expansion phase, Bitcoin tends to perform extremely well. And when the ISM peaks, Bitcoin frequently approaches major cycle tops. What matters here is not a single data print. What matters is the direction of economic momentum. Expansion in new orders and production signals improving business conditions, and historically, that environment has been constructive for Bitcoin. There is an important caveat. This does not mean Bitcoin immediately enters a new bull market. One reading does not create a trend. The real power of this signal comes from persistence. When the business cycle improves over several months, liquidity conditions improve and risk appetite returns. That is the backdrop in which Bitcoin has historically performed best. So, where can Bitcoin realistically form a macro bottom? From a high time frame structure perspective, the highest probability zone remains roughly the $52,000 to $72,000 region, with the most important area around the mid-range pivot near $64,000. The goal is not to pick the exact low. What matters is how Bitcoin behaves inside that zone. If real demand appears, confirmed through sustained ETF inflows and a consistently positive spot premium, the market can begin transitioning from defense into accumulation. The final takeaway is simple. We're not buying narratives, we're watching for structural change. The business cycle turning is one of the most important macro inputs for Bitcoin, not for a short-term trade, but for the next phase of the cycle. Use any relief moves wisely, rebalance into quality, reduce exposure to structurally weak assets, and position for strength, not hope. Thanks for watching the Crypto Code. If you found this video helpful, please like, subscribe, and hit the notification bell for more crypto insights. Let me know your thoughts on today's video in the comments below. You can also check out what we do here at the Crypto Code by registering for one of our free workshops where we show you how we and our students profit in crypto no matter if the markets are up or down. If you register for the workshop, you also get access to a free weekly trade alert. Attend our free workshop, take a short quiz at the end, and we will send you $10 in Bitcoin. No purchase needed. We have already given away thousands of dollars worth of Bitcoin just this year alone. Just look for the link in the description of this video to register for the workshop. It will be worth your time. Our public trade record currently has a 93% win rate, and you can view it here. Best of luck with your investments, and remember to stay informed and stay safe in the crypto world. See you next time.